Hey, everybody, it's Mark Yegge here, host of the Wealth Architect podcast. And today we're going to continue talking about one of my favorite topics lately, and that is the topic of a conservation easement investment. Now, if you've watched my last video about the conservation easement, it was a masterclass. I taught you all about what it is. If you haven't, go check out that video over here somewhere, one of those. Click on that, go back and watch that video because it's a pretty cool video about how it works. But I'm going to go over a couple of the ways that it works today. And today I'm specifically going to focus on the pros and cons of that investment. All right, so what are the pros and cons of a conservation easement? Well, I want to keep it simple and I want to keep it fairly high level, but you got to know about it if you're interested in these things because they're really, really cool. First of all, they protect the land from the development. So they basically, you take a piece of land, you put an easement on it, or you donate the easement, or you donate the property itself, and you restrict it from future development. That's how it works. You protect it from development. By doing that, you take the property out of the profit motive and you get a big deduction from the IRS. In fact, you get up to 50% of your adjusted gross income, and it's more than the typical 5 years in a standard, charitable deduction. You get 15 years to deduct it. It's covered by IRS code 170H. So they're giving you an incentive to make property green. Green's a big movement in this country. So if you're going to do it, you might as well get an incentive for doing it, right? And then finally, this is a big investment that's popular with the wealthy. I'll explain that in just a second. Now, here's how it works. You've got this LLC that donates property to a government or a nonprofit entity, like a land trust, for example, and they take care of the property in perpetuity. You determine the value by creating a before and after appraisal from a third-party appraisal company, and then investors can take those deductions for up to 15 years. So Donald Trump is a big benefactor. If you watch my last video, he created a $39.1 million deduction in 2005, basically saving himself $20 million in taxes. And basically all he had to do was say, I'm not going to turn my golf course into a development, and record a deed that said that. And by doing that, he made himself $20 million in taxes, or he saved himself that. That's like making yourself $20 million. And what he did, the way he did it was he appraised the golf course for 33 lots. If they ended up developing it for 33 lots, it was $49.5 million. By not developing, it stayed as a golf course at $10.4 million. Mar-a-Lago did the same thing, got a $5.7 million deduction by designating certain parts of Mar-a-Lago, and it's a very old piece of property, as historical features, which is a conservation use. And he basically saved himself $2.8 million at the time. I mean, pretty smart use of tax conservation easements in the tax code, right? I mean, that's what the IRS gives to these wealthy people, and that's what wealthy people are supposed to be able to utilize. Like, there's no shame in it. And by the way, on 4 properties, Trump basically took $120 million in tax deductions and saved what they estimate to be about $60 million using a conservation easement. All right, so what are the pros of the conservation easement? First of all, like we've been talking about, it's a tax deduction up to 50% of your adjusted gross income, or up to 100% if you're a farmer, for 15 years, not 5 years that they normally give you until the deduction is used up. It protects the land. The owner can still farm and use the property. It just can't be developed, right? It's customized to needs of the owner. If you want to put a certain something on it, you want to designate a house to be there, you can do all those things, but you've got to be able to customize it up front. It creates green spaces. It creates public benefit spaces. Think like a park or a playground or baseball diamond or facility, or both of those, right? Combining all that together. And the owner can generate a legacy for himself. And this is where they created this. It was these wealthy owners who had all this property, and they didn't want to just give it to their kids outright because the kids could sell it or develop it or whatever. And they didn't want it to be developed after they left. They wanted to preserve it as a legacy. So that's what it allows you to do. It can create what I call an instant ROI when it's used as a deduction. Rather than waiting and buying an investment and waiting for it to appreciate, you get that ROI immediately when you use it as a deduction because you save that money in taxes. That's like an investment. The government doesn't have access to your land unless you grant it to them. And you don't have to grant public access It's just one of the options. So it's a common option. You give the government access to your land. They use it as a public park, things like that, but you don't have to do that. Now, there are some cons when it comes to conservation easements. First of all, you may not be able to market the property in the future. Makes sense, right? Like you're limiting a use for the property. You can't develop it. Well, who wants to buy something that you can't develop? Well, they're going to take a playground and maintain it as a playground. It doesn't make sense. You're not going to be able to sell it, most likely, right? But you're not in it for that. You're in it for the tax deductions and the preservation. You've got to file the proper forms. This is very important. You got to file the right forms. You have to have the right third-party appraisals. They've got to be done right. And then you've got to have all your I's dotted and your T's crossed in your documenting of the transaction. It's really important. A land trust actually needs to go out and physically inspect the property every year. So if you donate it to a land trust, part of the deal is that they have to go put their eyes on it. Now, do they? Well, a lot of land trusts don't have a lot of money hanging around, and maybe they don't have the personnel to go out and do it, but they're supposed to do it. And, you know, if they do it once every 2 years instead of once every year, that's less intrusion on you if you're still working the land type of thing. All right. The owner or the property may not qualify. So as an example, let's say you have a high rise. Well, the property is basically used up for the high rise. It's not like there's green space around that you're going to be able to donate. It's just not the right use for it. So it really may not qualify. And there's a bunch of other things that may not qualify the property too, but you know, generally if somebody's offering a conservation easement, it qualifies. And then if it's not structured property, you could lose your right to the land, not the rent, to use the land in a way that you want in the future. So if you haven't thought about it, let's say you want to eventually put a house there. Well, if you didn't think about that in advance, they may not allow that use, right? The IRS may not allow that use, or the conservation easement may not allow that use. So I've talked about the numbers in another video, and you can go watch the masterclass video and I go over some of these same numbers. But let me give you just a quick example. In this profile, for every dollar that you put in, you get a $3 deduction. So every $100,000 that you invest to buy a portion or all of a conservation easement, you get a $300,000 deduction. A $300,000 deduction saves you $150,000 in taxes at a 50% tax rate, federal, state, local, all that kind of stuff. So that makes sense, right? Now, let's see it in action. So let's say you have this investor that makes $2.1 million. So without the easement, their tax team came together, they got it down, their adjusted gross income with deductions and things like that to $1,774,500. Okay. 1.7 million basically. Okay. Now your taxes at the 33.5% effective tax rate there are going to be a whopping $703,500. Okay. You still make $1.4 million. It's not the worst thing in the world, but now with the easement, you bring your adjusted gross by half. You bring it down by half. So now instead of being 1.7 million, it's 887,000. Nice little savings on your AGI. And then even with the cost of the investment, it's a $553,000 tax cost, which is a lot lower than $703,000 that you had without the deduction. So at the end of the day, you end up making 1.546 million instead of 1.3 million or 1.4 million. Basically, you get a gain in your net income of $150,000 that you get to keep. That's your money. And it's an instant return on your investment of 85%. You immediately that year made 85% just by making that investment into the conservation easement. And you brought your tax level down to 29% as your new effective tax bracket. So I hope you see that there are some major benefits to this. There's some cons as well. I think the benefits outweigh the cons, and the IRS wants it that way because they give you incentive to basically take the deduction so that you can preserve property for future generations. So you've got to know the pros and cons of any investment. And now you're ready to go out and find a suitable conservation easement because now you're armed with all the tools, you know what they are. And the main thing I want to say is that you should run it by your professional team when you find one and just make sure that it's good for you. It's right for you. It's right for a lot of people that make a lot of money that are in the high tax brackets. Just got to make sure that it's right for you. All right. So I hope that was helpful. I have a series of videos on conservation easements. So if you poke around on my YouTube channel, Mark Yegge Team, you should be able to put in conservation easement in there and find a playlist with these conservation easement primers. And I think, and I hope that you've been able to enjoy them.